Hi everyone! Stock markets are gripped by bearish sentiment. Last week, the Fed crushed investors' hopes for a softer stance in the near future. Although the regulator pledged to make smaller rate increases, monetary tightening is likely to last longer than expected. The new dot plot projections show that the key rate may rise above 5%. Recession fears have intensified once again following the Fed's decision to stick to a hawkish stance. Analysts fear that economic downturn may occur next year. These fears led to a large sell-off of risky assets. Wall Street has been gradually declining since Wednesday, with stock indices shedding more than 1% at the end of the week. Thus, stocks have been extending losses for the second week in a row. The economic outlook got gloomier after the release of worse than expected PMI indices for December. Additionally, factory orders dwindled to a two-year low. On Monday, stock markets managed to stabilize. However, their movements will largely depend on the incoming data and analysts' forecasts. Stock indices could drop further due to pessimism and high recession risks. If so, the odds of a Santa Claus rally will be extremely low. Given the downward reversal last week and the upcoming Christmas holidays, there is still a chance for a rebound. Watch our video review and find out more curious details. Leave your comments down below. Let's start. The outgoing year has been rather wild. Market players were hoping for a strong post-coronavirus recovery. However, those expectations were false. Galloping inflation and the energy crisis turned out to be black swans that ruined all the forecasts. The bear market is likely to persist next year. If US GDP has expanded by about 2% this year, next year the economy is expected to grow more slowly. Under the most optimistic scenario, it may rise by only 1%. The majority of analysts reckon that the figure could be just 0.5%. The main reason for an economic contraction is monetary tightening. As seen, there are plenty of weighty reasons for investors to be worried. Perhaps the situation will improve next year, however, inflation could accelerate by 5% instead of 2%. Mid-2023 is expected to be a tipping point. Things are likely to start looking up from that moment if, of course, nothing happens. The geopolitical situation remains unstable, borrowing costs are high and business activity is low. Apart from that, the regulator is still unable to tame soaring inflation. Naturally, those are long-term prospects, yet investors are factoring them in. As for the short-term outlook, it is also quite dismal. China struggles to curb the virus spread. So far, its attempts have not been crowned with success. It is also weighed on the sentiment. Investors are now focused on US macro stats as well as earnings reports. This week, Nike, FedEx and General Mills will unveil their earnings results. However, the most crucial reports are on tap on Friday, namely US GDP data, the PCE index and the US personal income and spending report. The Dow Jones Index lost 1.7% last week. On Monday, there were clear signs of recovery. Nevertheless, the index was unable to break out of a downward channel. All three benchmark indices entered their negative territory from time to time. Analysts are extremely concerned about the stock market. Although the losses are insignificant, they are worried about a sharp decline that occurred last week. The events of last week were more or less predictable. There were no unpleasant surprises. Inflation slowed down as expected. The Fed hiked the interest rate by 50 basis points as anticipated. Why did stocks slide down? Perhaps investors had already priced in all positive factors. As a result, there were no drivers for further growth. Besides, recession fears came back in full force. A looming recession is likely to be the main catalyst for stocks until the end of the year if the sentiment does not improve all of a sudden before Christmas. Anything can happen, but the chances are slim. Last week, many leading banks and think tanks predicted a new wave of a sell-off on Wall Street. The sell-off that occurred last week affected almost all sectors save for energy companies. However, even their gains were rather small, amounting to less than 1%. Shares of cyclical companies from the consumer sector and stocks of the commodity companies incurred the biggest losses, dividing by 3%. Shares of tech company DocuSign showed the best weekly performance, soaring by almost 30%. The S&P 500 index settled below 4,000 last week. It dipped by more than 2%. Notably, the index moved below the uptrend line that appeared in October. This is why it is unlikely to recover in the short term. Its drop also diminishes the chance of a Santa Claus rally. If it breaks below the long-term support level of 3,700, it may significantly undermine the long-term bullish trend. At the same time, a rebound may also take place. A buy signal will appear if it climbs above 3,900. Should the index break through the psychologically important level of 3,915 located near the short-term resistance level, it will create new entry points into long positions. Traders are now more interested in long-term prospects rather than short-term ones. The year 2022 is coming to an end. They want to learn what to expect next year. Judging by the dynamic of the index, the situation with risky assets will become clearer soon. Demand for these assets has been low since the start of the year. There have been some short-term rallies this year, but they were of no importance. When assessing the prospects of risk-sensitive assets, one needs to take into account the economic situation. Traders are unwilling to take risks in times of economic uncertainty and recession. In this case, investors also pay attention to the yield curve. Jerome Powell said that the Fed is closely watching this indicator. The yield curve is significantly inverted. The monthly government bond yield is considerably higher than the yield of 10-year ones. This is quite an ominous sign for the economy. It's hardly surprising that many analysts are drawing parallels with 2008 crisis. However, a similar situation also occurred in 1980s. Back then, the Fed was aggressively raising rates, hurting the economy. Aggressive tightening is highly likely to cripple economic expansion. Many economists anticipate the US GDP figure to shrink. Investors should factor it in when choosing a trading strategy for the next year. Risky assets are unlikely to recover next year. There could be a short-term rally similar to the ones that took place in the outgoing year. The NASDAQ 100 turned out to be the main loser last week. It shed 2.8%. Its downward movement was not so sharp, although the week was rather eventful. Overall, it dropped by 4%. On Monday, the index made an attempt to resume an upward movement, but failed. It also faced bearish pressure due to Elon Musk's comments. Musk launched a poll on the social media platform asking whether he should step down as Twitter's CEO. He added that he would abide by the poll results. More than half of the Twitter users voted for his resignation. Twitter shares fell by 4%. However, they rose again later as the poll results could hardly be taken seriously. Apart from Twitter, investors were discontent with Musk for another reason. He disclosed another $3.6 billion in stock sales on Wednesday, taking his total near $40 billion this year. Tesla shares took a nosedive to two-year lows in 2022. A U.S. securities filing showed Musk unloaded 22 billion shares over the 3 days from Monday to Wednesday. The sale is the second big chunk of stock he has cashed out since his $44 billion purchase on Twitter in October. Notably, he repeated many times in April that he was done selling Tesla shares. Tesla stock is extremely popular among retail investors. However, they are likely to be less willing to buy Tesla shares due to Musk's controversial decision. That is all for now. Thanks for watching and subscribe to our channel and stay up to date with the latest market news. See you.